Good afternoon. I want to thank everybody for logging in today and calling in for our special webinar that we have today on crowdfunding with real estate. Those of you who attend a lot of our webinars are familiar with us doing a number of different topics where we talk about the IRA specifically and then buying real estate with an IRA or buying private notes or private placements with the IRA account. Today we brought in a guest presenter, and I'll introduce Heather in just a minute. She's with a company called Early Shares, and they do crowdfunding with real estate. So you'll be able to learn a little bit about that. I just want to quickly go through a few slides just on our company for those of you who are unfamiliar with Advanta IRA. My name is Scott Maurer. I'm the Education Marketing Director for Advanta here in Tampa Bay. I've been with the company since early 2006. I'm also a licensed attorney. I don't do any legal work for Advanta clients, but I do at least hold the degree. And I am a certified IRA services professional. Got that certification and designation back in December of 2012. And who is Advanta? Just a little bit about our company. We're a local self-directed administrator. I say local in the fact that we can work with a lot of people obviously here in our geographic area. But we do have a local feel even to those individuals who don't live close to our office. We work with a number of individuals all over the country, whether they're other parts of Florida, the Northeast, even some clients we have on the West Coast. And we only administer self-directed IRA accounts. We do not handle any non-qualified money, so it has to be an IRA account, an old 401k, something like that that an individual is looking to use to invest in different alternative investments. Could be real estate, could be a private placement, as things we'll talk about today with the crowdfunding, could be a number of other different things as well. I would encourage you to attend some of our other webinars, some of our other seminars to learn a little bit more specifically about self-directed IRAs if that's what you're interested in. Again, today's presentation is going to focus primarily on doing some crowdfunding. Just a quick disclaimer on Advanta IRA. We do not provide any investment advice or endorse any products. We're certainly bringing in Early Shares today to talk about a concept. Whether or not you would want to work with Early Shares, work with other platforms, look at other investments, that's completely up to you. We are willing to work with those individuals, and if you need legal, tax, or investment advice, we can refer you to other people, other professionals in that area who could give you more information, give you more advice as you have specific questions. Now, why haven't people heard about self-directed IRAs? Probably the easiest, simplest reason. Most people have their IRA accounts with brokerage firms and banks, which offer them limited investment options. And they're simply not available in that particular account to invest in something like what Heather is going to discuss today, or if you're looking at buying a single-family home for rent or for rehab. Simply those accounts with those banks and brokerage firms do not allow for it. They could if they wished. They just simply choose not to. Self-directed IRAs really only account for about 4 to 5% of total retirement plan investments that are out there. The only restrictions the IRS places on investing in a self-directed IRA is you can't invest in life insurance, and you cannot invest in collectibles. And collectibles would include your artwork, your antiques, stamps, collectible coins, things of that nature. But certainly anything real estate related, or certainly anything that takes the form of a private placement, can be invested within an IRA as well. You just have to have the right type of an account, i.e. a self-directed account, in order to do that. Now, the other area where the IRS does restrict your ability to transact within your account is your IRA cannot transact with certain disqualified persons. So if one of the individuals named on this screen, you let yourself as the owner, your spouse, parents, grandparents of yourself, or your kids, grandkids, and spouses of those individuals, and also as important as today's presentation, any business or entity that is owned or controlled by one of the above, your IRA cannot transact, cannot participate that. So kind of in the context of what Heather's going to talk about, if you're looking at investing in a crowdfunding project that is being started and run by someone who is a disqualified person who might receive a salary, who might receive some type of compensation, it very well could be a prohibited investment for your IRA to make. But if you're looking at dealing with third parties, really there's really not much limitation the IRS puts on you with as far as the investments. Now again, what we'll talk about today is real estate at its core, but the investment takes the form often of a private placement. Individual investing into a large LLC or a large LLP, even maybe a private corporation, it looks like a type of investment that a brokerage firm might handle. It's kind of like a stock. But it's a private placement, something that's not publicly traded. So those banks and brokerage firms are not willing to hold those types of assets. And again, it can be private stock, could be a C corporation starting up, could be an LLC, could be an LLP, could even be a private trust perhaps that your IRA is investing into either 100%, it's the sole owner of an LLC, or maybe you're putting your funds together with a number of other individuals in an LLC, or maybe you're looking at doing a crowdfunding type investment that we're going to talk about now. And at this time, I am going to introduce Heather Lopes. Heather is the co-founder and Chief Strategy Officer for earlyshares.com. It's a crowdfunding portal. We're very happy to have Heather on as a presenter today. At this time, Heather, I'm going to turn the presentation over to you to tell us a little bit about investing in real estate crowdfunding.
Perfect. Thank you so much, Scott, and thank you all for being here and having me. So as Scott was touching on, and using a self-directed IRA has been such a great way of unlocking some of the capital that has been on the sidelines and kind of forgotten about, and actually having the control and the ability to make your own investments into these private offerings and private placements in alternative markets and marketplaces such as Early Shares. So just to give you a little bit of background about the company, Early Shares has been around for the past few years, and we were one of the first platforms to really contemplate equity crowdfunding as we know it and as it's evolving. And so what we envisioned and what we've built in identifying the problems that sponsors, that issuers, business owners have faced in raising money, number one, it's very difficult, very complex, especially when you need to adhere to SEC regulations. And number two, it's very tough to be able to connect with investors that you do not already have a pre-existing relationship to. So in learning about this new regulation, me and my co-founders came together and we built Early Shares. And let me just move the slide. So really what we're doing is connecting capital. And the first time in 80 years since this new regulation has been put in place, it has allowed people that are seeking money to connect with new investors, and has allowed investors to connect and have access to new opportunities. And so in that sense, in addition to providing those introductions and those new relationships, we have also built a technology platform that makes the fundraising process very seamless. So we hear a lot about crowdfunding. It's quite a buzzword. But really, crowdfunding, it's something that we've been doing for hundreds upon hundreds of years. As you can see in our example, Mozart, he crowdfunded his concerto. The first time that he wanted to do the concerto, he didn't have enough money. So he went out and he got backing from, I believe, a little over 100 backers, and he said, to support my work, I'm going to give you signed manuscripts of my concerto. And so he was, I guess you could say that he was one of the pioneers of what we know as Kickstarter type of activity today. But as you can see, it's an old concept. The base of the Statue of Liberty, that's something else that was crowdfunded. So just really interesting concept, very similar to passing the basket around at church. But what we've done is through the development of these major networks online and through technology, we've just wrapped what we've been doing for decades, wrapped technology around it to make it more efficient, more streamlined. So really quick, let's take a look at the regulatory framework that enables us to do this type of fundraising. So if you look at the Jobs Act, there's 7 titles total. At Early Shares, we focus on 2 of the titles, Title II and Title III. So Title II specific, it lifts that ban on general solicitation. So very simply said, it means that if you're raising money and you're not going to register your securities with the SEC, then you can do so in a very public way. You can have a billboard. You can advertise on the radio. You can host an offering on Early Shares. You can do a lot of different things to direct new investors to your offering. You haven't been able to do this before. The only caveat is that you can only accept investors that are verified accredited investors. So the old way of raising money where you would accept accredited investor commitments, it was a check the box by investors. Now as the issuer or as the person that is raising money, you have to take an extra step and make sure that those investors are indeed accredited. The second piece of the legislation we focus on, Title III, that is the true form of equity crowdfunding. And what that does is open up these types of private placements and alternative investments to everyone, regardless of their income, regardless of their net worth. And so everyone can be able to participate. And really what that is democratizing the access to capital and where capital is placed. So let's take a look at the market really quick. There's huge opportunities in this market. Commercial real estate stands out to be the most. Right now we're looking at an $11 trillion marketplace just with commercial real estate transactions. In studies and surveys done with individuals that have investment portfolios, more than 75%, more than 3/4 of them already own commercial real estate in some form or fashion. If they're doing so through a publicly traded REIT or if they're doing so directly through the direct ownership. Real estate has historically been the #1 choice of an investment for wealthy individuals. And so let's look at the market space where it is today. As you can imagine, given the opportunity I just talked about, that there's a lot of players that are involved. And in looking at the way that you can publicly fundraise, there's actually a few exemptions and a few ways that the securities laws and regulations allow companies, allow individuals to fundraise. And so each of these different platforms, they are specialized in itself in the type of offerings that they focus on, or the type of regulations, or even the type of investors that they're focused on. So this type of fundraising where you're utilizing general solicitation and the ability to publicly fundraise, even though the Jobs Act was passed back in 2012, the SEC just put forth some of the final rules and regulations for Title II back in September of last year. So we're almost a year into this market, and just looking at some of the statistics, you can see what types of industries are attracting this type of capital, and obviously at the bottom, real estate is #1. So we've seen close to $200 million be invested in new 506C transactions, and clearly real estate is leading that volume. And so why would somebody invest in real estate? I mean, there's a lot of different benefits. Look at the marketability factor and the tangibility factor. When you talk about real estate, it's very easy to understand. You can actually go touch and feel it and go see it, drive by it if it's something that is more individually focused, if it's an individual offering. So if you're offering, or if you're looking at an offering that is a CVS that is on the corner of 1st and Main in your hometown, it's something that you frequent, that you shop in, that you can touch and feel, and you can actually see it. It gives investors a lot more comfort. There's also clearly defined terms. So you've got the underlying collateral, you've got the cash flow, you've got those dividends that are reoccurring. Obviously depending on the underlying tenants within the property. And then you have pretty clear time horizons. How long are those tenants in the property? Looking at who's putting the deal together at the principal or the sponsor, looking at what their objective is for the property. Are they going to reposition it? Are they going to seek out national tenants? Are they going to increase rents? I mean, there's a story that goes behind real estate investing. Obviously, real estate has consistently shown a history of very strong returns. So it's easy to look at historically what certain asset types or certain tenants have performed and how to project that going out. And then at the end of the day, I mean, it's all about control. So individuals now have access to individualized properties by being just a small equity holder, where before if you wanted to invest in that CVS I used as an example, you had to buy the whole thing. Well, CVS's trade are sold anywhere between $2 and $15 million depending on the size, depending on the rent, depending on where they're located. So that's a big check to write. But if you want to put $10,000 or $25,000 into a little piece of that, then through equity crowdfunding and through platforms like Early Shares, you can do that. And so really quick, it's important to understand what goes into an offering before you actually see it online. So there's a very significant, very deep vetting and selection criteria that we use. And one thing I wanted to mention is in addition to real estate, we also offer emerging growth company opportunities on Early Shares. So really quick, looking at the requirements for real estate, the first, second, and third thing that we look at that's priority is the sponsor. Let's look at the principals in the transaction. We want to see what their track record has been. We want to see what their experience has been within the asset class that they're trying to do their offering going forward. And that is such a key piece of the process. Because if you go back, we're in 2014, you go back to 2007, 2008, those experienced investors, they've been through really rough times, and they know how to position themselves in case rough times come again. And real estate, it's just like any other industry that's very cyclical, so you have to plan for the good and you also have to plan for the bad. And the principals that we work with have already been there and done that and have shown a track record of positioning themselves to do that. On average, our principals have at least 10 years. Looking at who's raising money on the site now, they have average of 20 years plus. But as a minimum, we require 10 years. And they've invested or been a principal in at least $50 million of transactions. We're only focused on US-based projects, although we have gotten quite a bit of interest in raising offshore. That's not something we're looking at right now. The average transaction size of the offering is anywhere between $2 and $30 million. And then at a minimum, we require that principals have their own skin in the game. So they at least have 10% of the equity that is raised of their own funds in the deal. So really quick, I'm just going to touch briefly on what our requirements are for emerging growth companies. You know, again, going back to who is behind it, we look at the team first and foremost. What is unique about them? What's the problem that they're solving? Is it important? Is it important just to them, or is it important to a broader community and a broader base? What traction have they accomplished, and what's been their prior funding history? So also a second component into what goes on behind the scenes before an offering goes live. Aside from the vetting, it's also the due diligence. Due diligence is such a key and is so important to doing online offerings. Because when you think about it, in this new industry, you've got new issuers that are raising money publicly without being registered, new regulations using the Internet. So the first thing that is always asked of me whenever I'm speaking is, well, what about fraud? I mean, it seems like this industry would be riddled with fraud. And then I revert back into our due diligence process and our due diligence partner, CrowdCheck, and analyze and look and see what they're doing. So they are doing that independent third-party verification of the principals and of the sponsor of the issuer. So are they authorized to raise money? Have they filed all their forms appropriately with the state? Are they in good standing? They are claiming that they have already purchased this property. Well, let me see the purchase contract and let me see the transfer paperwork and the warranty deeds, etc. So they're doing a lot of that independent fact-checking, and that is all of their work is incorporated into the offering page on Early Shares. So it's very transparent. You can see exactly what was done, and then there's underlying proof attached to the individual sections to back up the work that they have done. So it's something that's creating secure, it's creating more of a comfort area for investors that don't have a pre-existing relationship with people that are raising money on the platform. It just gives them more of that confidence that this due diligence has been done. And interestingly enough, I look at a lot of the angel groups and some venture capital groups do their due diligence, and it's not as comprehensive as this. So it's something that is unique to early shares, something that we're very proud of. Every company that goes on the platform goes through this crowd check process. So we've taken this pretty vague, pretty informal, little complicated, no access. We've looked at this space and said, how can we make this an easier process? How can we make this an easier transaction for our investors to feel comfortable in investing? So we've simplified all the steps into 4 steps. So the first thing that you need to do is join the platform. So the first thing we're going to ask you when you join is, what is your status as an investor? Are you accredited or are you unaccredited? Because that's really important. As I mentioned, unaccredited investors cannot participate in the offerings currently because the SEC hasn't finalized those rules and regulations yet. So we're focusing on working with accredited investors. And really quick, just to go over that definition, as you can see, you have to have a minimum income level of $200,000 individually, or joint filing with your spouse, $300,000 for the past 2 years, and have the expectation to make that moving forward. Or, it's not an and, it's an or, a net worth of $1 million excluding your primary residence. So one thing to consider when looking at platforms like Early Shares or any of the other competitors that I mentioned earlier is looking, what is their vetting and what is their due diligence process? How can I get comfortable as an investor in participating in some of the offerings on their platform? What does their underlying compliance look like? So I joke around, but it's a very serious statement that I do not look good at orange. Orange is not the new black for me, and we are incredibly jail adverse here at Early Shares. We are compliance focused. So part of the service that we offer to our issuers is providing them the guardrails to be compliant in utilizing these new regulations and fundraising under 506C. Looking at the types of transactions, and then lastly looking at the deal structures and getting comfortable with all of those steps. So the second thing is, take a look, do some browsing, do research online. We have built a digital deal room, which I'm going to show you in a few slides, that aggregates all of the information that's important to understand the opportunity, and which would lead to doing your own due diligence, or which would also lead to having a conversation with the issuer. So review who the people are behind the team. Also do your own research and doing some social network checking. Look what their profile is on LinkedIn. Try and find them on Facebook. Try and find them on other databases. Get comfortable with them. That's the most important thing. And then review all the documents. All of the subscription documents are online, appraisals, insurance certificates, all the investment terms, everything that you need to know just to give you kind of that overview of the investment is aggregated for you very nicely in the offering page. The next step is make your commitment, invest. So what we've done is we have embedded all of the offering documents and the subscription documents online. So once you're ready to move forward with an investment, you electronically sign everything. Very simple. You get a copy immediately after you've signed. The issuer gets a copy for them to countersign, and once that document has been formally signed by both parties, each party gets a completed document. At that point, that's when we're going to do that verification of accreditation that's required by the regulation. So there's several different ways that we work with investors, and we're flexible as long as we adhere to the regulation. Last step. Support the project owner, support the principals, share it. So if you feel comfortable in investing in it, more than likely, your friends or your family, they may like it too. So share your investment and also stay engaged and keep the lines of communication open with the project sponsor. Because as you know, with real estate companies, they're not just doing one deal. They're doing several deals throughout the year. And so once you get comfortable with them, and once you realize what their strategy is and that aligns with your strategy, then it's something that you may want to participate in their next deal, So really quick, this is exactly what the offering page looks like. This was a successfully funded transaction by one of our sponsors. Did a project. It was a multifamily project in St. Petersburg, or in Tampa, Florida. 192 units, offering some very nice returns. But again, everything was very transparent. We had a couple of investors that did site visits, which is totally okay for our offerings and can be coordinated directly with the project sponsors. So you can see that we incorporate who the sponsor is, who the team is, some information about the property, all the relevant investment details, the supporting documents, and that due diligence slide that I referred to earlier. Then we have a Q&A board. So if you have a question for the sponsor, you can ask it through the board or you can ask it directly. And so if you post your question through the Q&A tab, the sponsor will answer your question there. And then the last tab is the update tab. So let's say that the sponsor gets better loan rates or better loan terms, they get a new tenant. That's something that they're going to share there in the update tab. So pretty much Early Shares is a turnkey solution that enables access to investors for new real estate opportunities, and it goes the other way. So this is a great opportunity if you're raising money. It's a great opportunity if you're looking to diversify your portfolio further, and you can do so everything on Early Shares. So thank you so much, and I'll turn it back over to Scott.
All right, thank you, Heather. I forgot to mention at the very beginning, if anyone has any questions, please type them into the chat box. We did have one question come up, and I had a couple as well, just to hopefully answer maybe some things other people are thinking about. But if anyone who's listening has a question currently, please go ahead and type it in the chat box so we can make sure we get it answered. Heather, the first question came in was asking about, you mentioned that there's the Title II is for accredited, but then there's the non-accredited investors potential. The question was, aren't some of the other crowdfunding platforms already making this available to non-accredited investors? I don't know if you can speak to that or not, or if there what reasons they might have, but that's the first question we have.
Absolutely. So thank you, RJ, for that question. And yes, you're absolutely right. There is one platform that it's called Fundrise. They're based out of DC, and they're utilizing Regulation A, which means that it's almost like they're doing an IPO. So they're formalizing the investment opportunity. They're filing the paperwork with the SEC and registering that offering. So they were able, even though it takes 6 or 7 months to complete that process, I think the SEC maybe does 12 or 13 of those transactions a year. Once they complete that process, then yes, you register with the SEC. You also register with the states that you're going to be offering that security out to, and you can accept investments from unaccredited investors.
All right, Heather, I had another question pop up, and again, I have a couple as well that hopefully people will find interesting. But a question came up from Ed, the costs and fees that are paid to, obviously you all are a for-profit business, so the costs that you all might have for your services, are those paid by the sponsor, the investor, or both? I guess that's where that question's going.
So the investors, there is no cost to participate in our offerings. It's an open platform for investors. For issuers and for project sponsors, yes, there is a cost, and that cost it's a flat fee. So it's customized. It depends on all of the services that those issuers utilize from us, and our services encompass marketing services, PR, access to the platform, syndicating on other platforms and other networks, and also just being there and helping you step by step by step. So they're flat fees. It's not tied to the success. It's not tied to the amount of money that they're raising. But what I can say, we can have more of an individualized conversation. But what I can say is that it's very low right now. We are in the process of becoming a broker-dealer, which will take effect sometime in Q1, Q2 next year. And so then our revenue model will change.
Heather, to follow up on the question from RJ earlier with the unaccredited investors, is there any expectation of when unaccredited investors may be able to be involved? Is there a time frame? I think you said they're writing the regulations now. Is there any expectation of when that would be complete?
Oh, that's a great question. That's fueled a lot of good debates. So looking at the Jobs Act, it was passed in April of 2012. Congress tasked the SEC in coming up with the final rules and regulations for the 7 titles before December 31st of 2012. Fast forward, September of 2013, that's when they came out with some of the final rules and regs for Title II for accredited investors. We're now September of 2014, and they are still struggling with formalizing the rules and regs for unaccredited investors. Back in October last year, they published a 600-page proposed rule report and also questions that they were looking for comment and response back from the industry. So the comment period was open until February of this year. I believe they got someplace close to 300 comment letters, and they're looking at all of the different angles from the industry perspective. I mean, there's a lot of rules that I'm not going to go into a lot of detail about right now that is up for debate. One of them is the shared liability of the platform and of the issuer, and also curation and vetting is a big question. So the SEC still hasn't gotten completely comfortable with it, and their timing, it's anyone's guess.
Heather, I had a question. I don't know how many people on the webinar maybe joined to get this kind of answer today, but if you had somebody who was looking at they're looking kind of for themselves, or not necessarily looking for a large commercial project, is there any future, you see any future involved where people looking for maybe doing a crowdfunding campaign to raise, say, $200,000, $500,000 or so to go buy some residential rental property? Obviously, I know you're dealing with commercial. Is that something you all see in the future, or is it just something you've chosen not to do?
No, we're seeing
at Early Shares?
Yeah, we're seeing at Early Shares, we're seeing a couple of clients that we're working with through the process. We're seeing that they are they've invested in single-family properties for several years, and so what they're putting together to offer is a pool of single-family homes. So you've got diversification within the underlying offering, and it's spanning over different states and different price points and whatnot. And you're seeing returns someplace around 8 and 9% on those portfolios. So it's something that's coming soon. You also see in the space, not on Early Shares, but there's a few platforms that are offering the fix and flip on an individualized home offering. So you'll have a $70,000 or $60,000 equity offering that somebody says, they found a home in Nashville, Tennessee, and they're gonna put some money into it and flip it for X amount of profit. So that's something that you're definitely seeing in the space. That's not something that we look at on an individualized basis on Early Shares. We're focusing on more of that diversified portfolio of single-family homes.
Okay, I have a couple of questions I wrote down just on the mechanics of the investment. Now, so far, again, right now you have to take accredited investors. If someone has an IRA account, I mean, we've done this a lot of other private placements as well. Is the IRA is its own kind of entity? Is the accreditation then still based on the IRA owner themselves personally?
Yes, absolutely.
Okay. And
IRA assets do count as part of that net worth test. So it's an income test or it's a net worth test.
When the people who've put together the crowdfunding to real estate projects, what structures are typically used? Is it an LLC, an LP, a corporation, and then who also selects what structure? That's something, are you involved in, or is it kind of what's presented to you?
Yeah, so the sponsor, they 100% structure their deal and customize it to what is marketable and what investors are looking for. And so with that said, real estate offerings are typically in the form of an LLC or LP or an LLP. It's a partnership or a limited liability company of some sort. Just because of the the liability protection and also the pass-through for a lot of the deductions associated within real estate. When you're looking at growth companies, those are typically structured as C Corps. It's just a lot friendlier in dealing with shareholders in doing public offerings. Sure.
Is there a minimum or maximum as far as each individual investor per project? Is there, if someone had an offering, say, $5 million, and they're taking increments, is there a minimum they set for the investment? Again, is that something that the sponsor puts together, or are there limitations in the law as far as how much one individual could do in put in a crowdfunding project?
Yeah, see, the beautiful part about Title II is that there's no limitation. So investors can invest an unlimited amount of money. However, I say that with a cautionary tone. You have to be very sensible about how much you're investing, and you have to analyze what your tolerance is, what your objectives are, and what type of investment risk that you can bear. So even the safest of transactions, something can happen and they could go bad. So you always have to be comfortable with the investment and have the ability to bear the risk. But in terms of dollar amount, the regulation has not placed any type of limitations on how much you can invest or how much a sponsor can raise. So they can raise an unlimited amount. That's for Title II. On Title III, there are caps from both an issuer perspective and an investor perspective. And then going back to the offerings now, the dollar amounts that you can invest, I mean, again, that's something that's dictated and structured by the sponsor. So you could invest a few $1,000s into an opportunity, or you might see that the minimum is closer to $100,000. So it's very dependent on the underlying principles, and it's very dependent on the underlying offering.
And a good question, do you see the sponsors asking for additional capital calls? Because that's a concern individuals might have with an IRA. There's a limited amount of funds perhaps in their IRA, and there's a limited amount they can put in on an annual year, in a given year. So the concern, I guess, potentially for an investor, utilizing most of their IRA funds or the ones that they have access to, if there is a capital call. I don't know. Again, I don't know if there's any rules on capital calls, or is again that something that goes back to the sponsors and how they've set up their investments.
I mean, that's a great question, and that's very relevant to consider. Capital calls, again, that's something that's dictated by the principal, but typically how I've seen it is in the event that there is a capital call, it's up if the investor has the ultimate decision whether they want to participate in that, and if they do not, then they would get diluted based on what the capital call is. So it's optional, but you also have to factor as an investor, what change that will happen to the ownership.
Okay, last question I have, and again, if anyone who's still listening or participating, if you have a question, please get it typed in here in the next minute or two. Just a question on exit strategies. Obviously, these are private placements. Is there a forum within early shares that allows individuals to sell their interest, or again, is that going to be limited by how the sponsor sets up the investment?
Yeah, so typically you see restrictions on the underlying securities. And so typically it's at the issuer's discretion on whether the issuers can trade those securities or transfer those securities. It's very important to read very thoroughly the underlying partnership agreement and operating agreement to see how that's handled. But just generally speaking from an industry perspective, there are secondary markets that are being built right now. Second market, I believe NASDAQ is in the process of building one. It's something that we will definitely consider maybe a year or two down in our progression, and incorporating a secondary marketplace for offerings that have occurred on early shares. It's definitely something to think about. So when you're analyzing as an investor an investment opportunity, you have to be aware of what the time horizon is and what the exit strategy is. So we have opportunities that are very short, that are 18-month expecting holding periods. We also have opportunities where the sponsor has said, I expect to hold on to this property for the next 10 years. So it's independent of each offering.
And I guess kind of follow up on that, you mentioned that you were looking at going through the process of becoming a broker-dealer. Is that because that would enable a client to invest with you through that and have a ready platform to sell that investment, or is that kind of unrelated?
No, it's unrelated. By being a broker-dealer, number one, it further validates who we are and just emphasizes our focus on compliance. And secondly, it enables us to recommend investments, where right now we are extremely objective in how we market the opportunities on our platform. We use very objective type of descriptions of how we offer and how we announce new offerings and any progress. It's something that can be independently tracked, and it's something that is very specific. So in being a broker-dealer, that will enable us to give our opinion and give our advice on underlying transactions.
Okay, and again, that same vein, if you are a broker-dealer, someone could then just open up the account would be open with you and then invest, or are they still investing directly into the project? I guess that would be.
They're still investing directly into the project.
Okay. Had another question pop up from Ed. Said, currently your website lists a few funded projects. What history do you have with projects that have paid out, sold, and/or closed? Any success stories? Kind of any of the current or past investors and sponsors you've worked with?
Yeah, so our sponsors, very experienced both on the growth side and on the real estate side. But one thing that you have to understand is that this public fundraising mechanism was only allowed back in September of last year. So being that we're conservative, we waited a few months before we launched our platform. We just launched in December. So we've funded a handful of projects. We've got several active projects, and we've got a pretty big pipeline of deals that are coming in the growth and in the real estate space. But I can't say within the 9 months that we've been operating that we've had a turnover, we've had a success story aside from funding transactions. That's our success story, and having the opportunity or offering opportunities to investors that they just would have never had on their own and independently, and also in connecting issuers and sponsors with capital that they would have never had independently. So I think that as this industry develops and as time goes on, you're going to start to see success stories, and I do hope that some of those happen sooner than later on our platform. I know that we have a couple of companies that are raising money that are debating and considering doing an IPO in the next year or two. So that would be a huge success story. There's also another company that we funded that has already been in acquisition discussions with a larger company. So it's something that you will see play out hopefully more often, but just a little bit more time needs to pass.
Heather, if you can, I guess we'll wrap up. I don't see any other questions coming up. Any final thoughts before we close out the webinar?
No, I encourage everybody, and thank you, number one, but I encourage everyone to register on the platform. I would love to get your feedback and love to get your opinion. We're always looking at ways to further make our process easier, simpler, more user-friendly. But also, look at the space. Look at this way of funding more closely, because this is definitely the way that that we're going within fundraising. It's something that you've got a lot of participants. You've got a lot of major institutional participants starting to look into getting into this space. One last thing that I'll leave you with, something within our development, is that we just formed a joint venture and took control of property.com. So something coming first quarter next year is a complete transformation of this whole commercial real estate space as everyone sees it today, that is being relaunched through property.com. So we're very excited about that.
Good. Anyone who wants to get a hold of Heather or Early Shares, here's the contact information on this slide for their website, obviously for an email and a phone number as well. I encourage you to call Heather with your questions on that. It's been a very informative webinar. We appreciate her coming on and sharing that information. And if you have any questions for me on self-directed IRAs, please contact me here. You can certainly email me, call me, or visit our website for our upcoming webinars and seminars. Maybe we'll have Heather back in a few months as well to present again. So Heather, thank you very much again for participating.
Great. Thank you so much for having me, and thank you everyone for listening.
All right. And this time we'll stop the webinar. And again, I hope everybody has a nice day. Thank you.